Hello everyone, and thanks for tuning in to the Financial Investor channel. My name is Brent, and today we're going to be doing our 5 stocks with X dividends next week. Now, this is the last segment for 2017, so this will be for stock dates December 25th through December 29th. So I have 5 stocks I picked out. I screened these out of 40 or so for their price to earnings less than 25, a yield greater than 2. So I screened it all the way down to 5. Then we're going to be covering their dividend dates, their price comparison yield, their price in comparison to the yield, their price to earnings to the average industry, the payout ratio, the dividend history, and more. So I took a little bit of time reorganizing this specific segment, and I kind of added a few different things, kind of color coded it, and then added my disclaimers at the bottom of each page to either data that I'm collecting or affiliate links within my website or my YouTube or Facebook and such. So I do have my privacy and disclaimer on my website now. So let's go ahead and begin covering our 5 stocks with X dividends next week. Now, the very first stock is Edison International, and this is one I just purchased the other day. They engage in the supply of electric energy in central, coastal, and southern California. As of December 31st, 2007, the company served approximately 430 cities and communities and the population of approximately 13 million people. So this has jumped up quite a bit since 2007. They're actually around maybe 17, 18 million, I believe now. Since 2007, they've also done a lot of acquisitions. They've started their turbine. It was like a wind hill, like 7 miles of just straight wind turbines, and they just completed it at end of 2016. So that was eating up some of their free cash flow, but they're going to be changing it around in the future. They've also had a 14% dip in the last 2 weeks due to the California fires, and I thought it was a great opportunity. So their ex-dividend date is on the 28th of December, which is next Thursday. So if you will want to get the ex-dividend, like be eligible for the date, you would need to buy the stock on Wednesday or prior. You would then get paid out on the 31st of January. So I do have their 1-year graph here. When taking a look at it, we can see that they pay out 60 cents per share. They just increased it. They declared a dividend increase in October, and they just increased their dividend by 11.52%. So very nice dividend increase there. They have a yield right now of 3.11, but this is actually incorrect because of the dividend increase. It's actually 3.46%, a little bit higher depending on the price that you're buying in at. Their current price to earnings is 15.99. Hold on one. Their current stock price is $69.86, and their price to book value is 1.83. So Edison International, when charted, it shows that the current stock has a higher yield to price, which would indicate it may be undervalued at this time. The stock is under in the industry price to earnings average. It is sitting below 60% payout ratio and has had dividend growth for 12 years, which I would consider recession proof. Its price to book value is 1.83, which is lower than 3, where value investors would consider a value. So here we can see that the price PE ratio is 16.3. This graph is showing 15.9. I pulled this off Morningstar, and this is directly off the live data. The industry average right now is 21. So it is sitting at a decent price to earnings average, which is actually below where they've been in the past, and they're moving to become more profitable in the future. So their current dividend yield is around 3.46. They pay out $2.42 per share for the entire year. So if you have 100 shares, 100 and you move the decimal, $242 for the year. Their payout ratio is 55.9, so it's underneath the 60% ratio I like to buy at. They've had dividend growth for 12 years, so they are considered recession proof. And they've had an increase annual dividend growth of around 11.52. I believe last year they had increased it by around the same percent. So very good stock overall. The next stock, ticker symbol, is USB. Now this is the US Bank Corp, and they operate as a holding company for the U.S. Bank that provides commercial banking and financial services in the United States. It provides a range of financial services, including lending and depository services, cash management, foreign exchange, and trust and investment management services. So a range of services, and it's a bank. So ex-dividend date is again next Thursday, so you do need to buy this one on Wednesday or prior to be eligible for the ex-dividend date, and then you would get paid out on the 16th of January. So they just announced a dividend increase back in what looks like July. So they went from around 27 cents to 30 cents, which was an increase of 7.14%. Their price to or their PE ratio, their price to earnings is 16.24. Their price is $54.57. Their current yield is 2.09, and their price to book value is a steady 2.09. So very nice across the board. So the U.S. Bancorp, when charted, it does show that the current stock is a higher price to yield slightly here. You can see that the yield was above a 2.2% nearly, and that has begun swinging back up in a positive manner. So it would be considered overvalued at this time. The stock is under in the industry price to earnings average. It is sitting below 60% payout ratio and has had dividend growth for 6 years. The price to book value is 2.09, which is lower than 3.0, where value investors would consider a value. So we can see the price to earnings is 16.3. The industry average is 18.9. The dividend yield is around 2.2%. Because of the increase, this shows 2.09, but they haven't paid a dividend since the increase. That's why this is showing the incorrect data, whereas this is correct. They pay out $1.20 per share. So if you had 100 shares, you get $112 per year. The payout ratio is 35.1, so very low. So even during tough times, they could probably their payout ratio may bump up to say 50-60%, but they could probably continue paying out through a recession. They have had dividend growth for the past 6 years, and then they had an annual dividend growth of around 7.04 or 7.14%. So I like to see growth over 5% in some of these blue chip companies, which this one does have some that growth. MDT, which is the Medtronic Inc., it engages in the development, manufacturing, and marketing of device-based medical therapies worldwide. The firm aims to produce products for alleviating pain, restoring health, and extending life for people with chronic conditions. The next dividend date is Friday, December 29th, so you do need to purchase the stock on Thursday or prior. You would then get paid out on the 19th of January. So they had an increase back in what looks like March. They declared an update. They've already paid out a dividend back in, they pay out in January. So they paid out in October, 46 cents per share. They're currently priced at around $82.01. Their price to earnings is 22.47. Their current yield is 2.17, and their price to book is 2.15. So Medtronic, when charted, it shows that the current stock is a higher price to yield, which would indicate it may be overvalued at this time. The stock is under in the industry price to earnings average, below 60% payout ratio, and has had dividend growth for 39 years. So this is very recession proof. Its price to book value is 2.15, which is lower than 3, where value investors would consider a value. So this is actually a nice looking stock as well. Very nice continuous dividend growth for more than 39 years right now. They just increased it back in March, and they're continuing to do so in the future. Their price has been on the downwards trend, so this may be kind of rallying and picking back up going in the future. So the stock is sitting at 22.9, industry is 39.6. They're currently sitting at around a 2.17, 2.24% yield. They pay out $1.84 per share. Their payout ratio is 38.6. So this one, even during recession periods like pullbacks in the market, this one has continued to pay out and increase their dividend year after year for 39 years. And their payout ratio is very low, 38.6, which is lower than a lot of those other companies out there that have been around paying out dividends for about the same time. Their annual dividend growth was 6.98. So even as long as they've continued to pay out dividends, they have a healthy increase of dividend per year. So You can see your initial dividend. So if you invest in this company and you use the rule of 72, you could initially see your original dividend payout double by the next 10 years. So whatever you put in at this current time, it would probably double after 10 years, even if you never bought another stock. But again, with compounding and dividends reinvesting into themselves with DRIP, you would end up with a very nice amount. The fourth stock is ticker symbol APD, and that's the Air Products and Chemicals, and they serve customers in the industrial, energy, technology, and healthcare markets worldwide, with a unique portfolio of atmospheric gases, process and specialty gases, performance materials, and equipment and services. Their ex-dividend date is again Friday, so you need to own them on Thursday or prior. Their payout date is the 12th of February, so quite a while till you would get paid out, but is it worth it? So they pay out 95 cents per share. They increased their dividends sometime back in 2017. They're currently priced at $162.60, which is pretty expensive. Their price to earnings is 11.90, so they've jumped. They fell from around a 55 price to earnings down to an 11.9, so their earnings have jumped up quite a bit, and their price had fell quite a bit, but they're actually becoming worth more now. So I would say that their earnings probably increased, which drove their PE ratio down. Their dividend yield is currently sitting at 2.28, which is probably at the lowest it's ever been this year, and their price to book value is 3.52. I have to get rid of that little thingamajig. The APD stock, when charted, it shows that the current stock has a much higher price to yield, which would indicate it may be overvalued at this time. The stock is over in the industry price to earnings average, under 60% payout ratio, and has had dividend growth for 34 years. So again, another recession-proof stock. The price to book value is 3.52, which is higher than 3.0, where value investors would consider a value. So this one, it is sitting pretty expensive right now. You can see the average is somewhere around 145, right in this time, this little area right in here. 144, 145. So it's been on a very huge streak. So I would definitely want to investigate what caused this company to have such a leap recently in their price. What caused their earnings to increase to the point where their earnings, their price in comparison to their earnings, had caused it to fall from nearly a 55 area down to an 11.9. Dividend yield 2.34, 2.28, right in that range. They pay out at $3.80 per share. Their payout ratio is 54.3, 34 years of dividend growth. And their last dividend increase was an increase of 10.47%. So very healthy increases in their dividend. And the fifth and final stock is ticker symbol CAH, which is Cardinal Health. Now, I know a lot of people, I've seen a lot of people talk about this one in the group chats that I'm in. And I know a lot of them are invested in the stock or have been picking it up recently. So Cardinal Health provides products and services to the healthcare industry. The company's healthcare supply chain services pharmaceutical segment distributes various branded and generic pharmaceutical products, over-the-counter healthcare products, and consumer products to retail customers, hospitals, and alternate care providers in the United States. So this one, it's mainly in the United States, so national. So it could be one to benefit very nicely from the tax deductions or the tax reform. So corporations will be taxed at a 21% tax bracket. So this may help healthcare stocks such as healthcare Cardinal Health. So again, their ex-dividend date is Friday, so you do need to purchase the stock on Thursday or prior. Hold it until Friday, so you'll be eligible for the dividend payout on the 15th of January. They pay out 46 cents per share. Their price to earnings ratio is 18.28. Their dividend yield right now is 2.9, which is one of the highest points of, there's a higher point. It did hit over an increase of 3.2% back in early, looks like maybe November timeframe. It had a yield of over 3.8, 3.18, so very high dividend yield. It seems to be trading back up, so this could be one to consider buying, add it to your portfolio, have it trail back up maybe $67, $68 range, sell off half and see where it's going to go as it continues either moving up or down. The current price is $62.87, so not too expensive. The price to book is 2.96. So Cardinal Health, when charted, it shows that the current stock is a higher yield to price, which would indicate it may be undervalued at this time. The stock is over in the industry price to earnings average, sitting below 60% payout ratio, and it's had dividend growth for 12 years, so I would consider this recession proof. Its price to book value is 2.96, which is lower than 3.0, where value investors would consider it a value. So the stock is sitting at 18.2, whereas the industry is 13.3 for healthcare. The dividend yield is 2.94, which is right around the correct area. Annualized payout is $1.85 per share. Their payout ratio is 37.3, so even in times of pullbacks, even if they fell to 50-60% payout ratio, they could probably continue to do nice increases. But their dividend growth has been kind of stale at a 3.01%. So it would take quite a while for your initial investment for the dividend payout to double. So quite a while there. And yeah, so those are the 5 stocks. I included a link here of how to use dividends to create a snowball effect. That's one of the books that I've covered in the past. And I have the link there in the description. So if I had to go and pick one of the stocks again, we have Edison International, ticker symbol EIX, US Bancorp, ticker symbol USB, Medtronic Inc., ticker symbol MDT, Air Products and Chemicals, ticker symbol APD, and then Cardinal Health, ticker symbol CAH. I would pick ticker symbol Edison International, just because in my opinion it is one that has trended down due to bad news, but the company itself has a lot of completions in their acquisitions. They have subsidiaries below them that are very profitable and getting, they're getting paid out very nicely on their own company's dividends. They have a high stake inside there. Just a great opportunity to buy right now on this dip. I believe because it did drop 14%, it is due to recover an increase of say 25% in the next say 6 months to a year, and it's trading at such a low price in comparison to its book value of all the assets that it does have, that it is well worth an investment, and that's why I add it to my portfolio. So again, that's just my opinion. I am not a financial advisor or tax specialist, so I am not providing financial advice, but just my opinion on these stocks. So that is it for this video. If you guys have enjoyed it, go ahead and hit the like button below. If you are brand new to my channel, hit the subscribe button on the bottom right hand corner to subscribe for future financial videos. If you guys have any questions about any of the stocks that were covered in this video, or if you guys are planning on other stocks to purchase next week, go ahead and leave them in the comments below. I am getting over a cold. You can kind of hear it in my throat. It's kind of building up and makes it very muffled, but I should be better here shortly and not sound like this. So that is it for this video. Thank you guys for tuning in, and I will see you next time. Have a great day. Bye.